My name is Kelly DePonte. I'm a managing director at Probitas Partners, and I'm here at SuperInvestor in Paris with George Anson, managing director of HarbourVest and also the current chairman of the EVCA. George, nice of you to be here. Wanted to talk a bit about the European market. As somebody based in the States, North Americans looking at Europe are wondering what the opportunities are. They're heavily focused on what's happening with GDP in Europe, but from somebody who's on the ground based in London, what's your perspective of the opportunity in Western Europe and in Central Europe?
Kelly, you know what? It is true that over the last 4 out of 5 years, European GPs have actually invested more money than they've raised, which some people might say is, a problem. But I think we've actually hitting or just gone past the bottom of what I view as being a cyclical downturn. If you look at the operating performance of private companies today, revenues are growing, profits are growing, and a lot of the deleveraging that's needed to be done over the past few years now is complete. I think evidence of an upturn as well you'll see in the debt markets, where we see a lot of debt refinancings going on at very favorable rates for the private equity community. And last but not least, we're also seeing a significant uptick in exits, very significant profitable exits by our GPs. And for instance, the run rate this year in 2013 is now well in excess of 2 times over what we saw last year. So I think the prospects are good, and at the GDP level, as we all know, 2014 is now forecast to be a better year in Europe than it was in 2013. So I think we're trending now in the right directions.
But I guess also when I take a look at private equity opportunities, very often when I look at the strategies of GPs, they're not highly dependent on GDP. What's your view of that when you're taking a look at the European market? Are there opportunities to generate superior returns based upon the strategies that various private equity managers have?
Yeah, absolutely right. Look, private equity fundamentally is about investing in companies and not countries. You're absolutely right. And of course, Europe has never been about a growth story. GDP over the last 20 years has averaged about 2%. And yet we know that private equity returns have been well in excess of that. So there's clearly a lot of operational improvements, professionalizing of management, industry consolidation that's gone on in Europe that has been driven by these experienced managers in Europe. And I think that's what the investment theses are today as well.
Okay. Are there any particular areas of Europe that you feel are more attractive? When in talking to some people back in the States, they look at Europe not necessarily in terms of Western Europe and Central Europe, but actually Northern Europe with stronger economies and Southern Europe, which have been more troubled through this last downturn. Do you see opportunities in both areas for you?
Well, I think, to be fair, there are opportunities in all these markets. But if you look at traditionally where capital has been invested, it has been largely in Northern Europe. And that's always been the case. And Southern Europe has had a relatively smaller proportion of capital invested. Has as much to do with the capital market systems and the cultural attitude towards private equity as much as it does to the economic backdrop or what's going on in the financial world as well. I don't think that's going to change. I still think the beer-drinking economies are probably going to attract more private equity than the wine-drinking ones are.
Yeah, but the wine-drinking ones will probably attract more tourists.
I think that's probably right, and they're always worth visiting.
Right. On the distressed debt side, through this downturn, there have been a number of people globally who have thought that there's going to be an excellent opportunity in the distressed debt markets in Europe. And a number of people, especially in 2011, beginning of 2012, were putting money into it. A number of people have been disappointed in those opportunities. And I know we've been talking about growing situations in private equity, but what do you think about distressed debt, especially with the Basel III regulations coming down that might shake things loose from the banks?
My simple answer would be it's too early to tell. But as we know in distressed and turnaround investing here, timing is everything. You can you can spot the opportunity, but get there too soon, and really not be able to capture the investment thesis that will play out over time. That said, I think now is a very interesting time to be investing in distressed opportunities and turnaround, and you can achieve private equity-like returns by investing with experienced managers. But more than anything, I think it does require a bit of patience, a bit of luck, and a bit of timing as well. And as far as the banks go with the deleveraging, it's always been the case that they've held off looking to write down assets or sell assets because of the rather benign banking environment we've had. Basel III, I think, could be the turning point.
Great. Thanks very much, George, for your opinions.
My pleasure. Thank you.